Financial independence has become a very popular buzzword over the past decade or two. What is financial independence? It's one of those terms that's kind of vague. So in this video, I'm going to clarify what is financial independence exactly, and I'm going to share 3 different ways that you can achieve financial independence. Because what you usually hear is that, oh, here's the way to achieve financial independence. You know, you follow this strategy, or here's the way to achieve financial independence. Anybody that's promoting their way to financial independence is because that's how they either only know that way, or how the product or service that they relate sells to that different way to achieve financial independence. By becoming aware of these 3 different ways that you can achieve financial independence, you can clarify which path you're taking, because one thing is for sure, we pretty much all want financial independence. You may also have a shift in the way that you view financial independence after viewing this video. Make sure you stay tuned to the end, because I'm going to share with you my favorite way to achieve financial independence and the method that we have used ourselves. The prevalent thinking in our society is that you work, sometimes doing a job that you really don't like or that's very stressful, while saving as much money as you can as a way to achieve financial independence. That's sort of the way that our system is designed. There's nothing wrong with that. By the time you retire, you start withdrawing typically around 4% that first year from your retirement savings, and you hope that you don't run out of money, because you're withdrawing that 4% every year, and that 4% has to increase every year for inflation so that you can maintain your purchasing power. This doesn't really sound like financial independence, but you know, ideally I talk a lot about retirement on this channel, and ideally financial independence occurs when you retire, right? Because, well, you have more time to do the things that you really want to do, and then you also ideally have more money to pay for them. So I'm rambling on a bit, because these are all important points that I think I need to make relating to financial independence. I want to say one more thing before I go over the first method for financial independence. These 3 methods for financial independence are going to make a lot of sense and may almost seem intuitive at the end of this video. You're going to go like, well, yeah, you know, but I was unaware of the ways that you can achieve financial independence when we stumbled into early retirement over 16 years ago now. I was unaware of this. I didn't know this, and I studied finance. I had taken a lot of financial courses. I invested for years, but I wasn't aware of this. And that's because most of what you hear about and read about is based on traditional financial methods, because there is an enormous financial services industry making billions of dollars on traditional investing and retirement methods that have been in place for a couple of decades now. So it's important to note also that none of the 3 financial independence methods are right or wrong for everyone. What is wrong is that we aren't taught about these methods from an unbiased resource. That's what I hope to provide with this channel. That's why I'm doing this. This information is based on what I've learned and I've experienced over the past 40 years as both an investor and a retiree, instead of just only considering that old method I was taught, I learned when I studied finance and investing, that old model of retirement is the only way to achieve financial independence. Okay, so let's get to financial independence method 1, and I call this financial independence method AAS. That's AAS, not, yeah, it's AAS for accumulate and spend. This first type of financial independence occurs, as I was just referring to, when you have saved enough money so you can pay for your desired lifestyle, ideally for the rest of your life. So this could happen in a number of ways. You could have gotten bonuses, or maybe an inheritance, or somehow you've gotten a lot of money, but you've gotten a lot of money so that you feel like you can pay for your expenses for the rest of your life. You're going to spend down that money with withdrawals. It's important that I mention two things about this method. So you've got an enormous amount of savings, and that's it. You've earned that money, you've inherited, you've gotten bonuses, however, you have that money and you're going to spend it down. So that is financial independence. Two important things to mention about this method are, first, it's really hard to know whether you've saved enough money in advance. There's always that underlying worry. Do I really have enough? And does it feel okay to spend this money because, ooh, I may not have enough? That's number one. And I've heard this from billionaires. I've heard this from people that have sold companies and, okay, maybe Deca millionaires. They have 20 million, but they're still worried about that as they spend money. So this is a common problem, no matter how much money you have. That's one problem with this method. And then two, I want to say this is probably the most ideal situation, but it takes a lot of money for the AAS method to work. A lot of money. This method concerns me even more now because as of this recording, almost all assets are overvalued, especially stocks and real estate. So that causes concern because most of the people that have accumulated wealth have it in real estate and or have it like in their home and or they have it in stocks and or bonds possibly. You can watch my other video where I talk about this, and I'll put a link to it in the description. Okay, so method 1 or AAS is the most popular and simplest investing method or simplest method, period, to financial independence. So I'm going to open up a very basic calculator that's on my website as of today to show you this. Okay, so here we are on my website, retirecertain.com, and if you go to Wealth Tools and you'll see the Runout Calculator right here, just click on that, and here it is. I give some short instructions, and I also have a link to my course here, and what you can do is enter your own data. So why don't we just use a nice round number, 500,000 here, so $500,000 on that. If you were planning on taking a more traditional retirement withdrawal of 4%, that would be 4% a year, and you would of course adjust that for inflation every year, which we're going to also have inflation in this calculator. So this will be $1,667 a month right here if you're going to withdraw 4%. And we're going to assume that that's going to increase every year at 3%, which is the average annual historical inflation rate. You can put in here whatever you want. The savings interest rate is actually what you're going to earn on your money, so your investment return, and I think 8%, the default, is a bit high. I think 6% is probably also, in my own opinion, overly optimistic for the next 10 years as far as a stock. If you have a standard stock and bond sort of 60-40 portfolio, I think that's probably overly optimistic in my opinion. But let's go with 6%, and let's just leave the federal tax bracket at 22%. It's hard to know what that will be. So let's just leave that at the default just to be conservative. And tax rates, of course, can increase. So we see that the money will continue past the maximum 30 years that you want the money to last. Now this time let's try a little bit more aggressive withdrawal of $2,500 a month, and we'll leave everything else down here the same and hit submit, and we can see that the money will last approximately 20 years with systematic withdrawals totaling almost $800,000. So that's how this works. You can come here and enter your own data to see how long your money will last if you're making withdrawals at a certain monthly rate. This is a really simple website I put up on my website from Calc XML. There are a lot of fancier, more complicated calculators that do this. I like this simple one. It was able for me to get up for my readers. So have a look and play with your own numbers there. I'll put a link to the calculator in the description, or you can also just Google Run Out Calculator, and I should come up within the first 10 or so showings after that Google search. Google's really changed the algorithms recently, so who knows, but retirecertain.com is my website, Run Out Calculator. Okay, so take a look at that. You'll also want to watch my best retirement portfolio video if you want to know more about how this works. I'll put a link to it in the description area under the video or to the right of the video, depending on how you're watching this video. Oh, by the way, if you're enjoying this video so far, I'd love for you to click the little thumbs up button under the video and let me know, and also subscribe to my channel so that you see more of my future videos on YouTube. Okay, Financial Independence Method 2, I call the IGA method, IGA. The second type of financial independence is when you have enough income to pay for your desired lifestyle. Again, ideally for the rest of your life, even though we can't know for absolute certain, ideally. And I feel like this method has a little more certainty, the income versus the just spending down the money. You may be thinking that this is the same method as method number 1, but it's definitely not so. So let me explain. You're living off income that you're generating with method 2, and this is by doing work that you really are okay with doing. Now, any income that you get, even if it's from dividends, you're collecting dividends from your portfolio, that requires a little bit of work. So with this method, you're doing work that's, I don't want to even use the term passive income because I just don't think it's real. I think dividends are really, they're not passive income. You've got to research the product that you're getting the dividends from. You've got to manage it. You've got to manage taxes. You've got to keep track and manage all of this. So nothing is truly passive. But I'm sort of referring to passive, mostly passive income, or maybe you're doing something that you are happy to do. You can watch some of my other videos on this. So let's take a simple example of the IGA method to make it more clear. Let's say you've got $1 million portfolio. That $1 million portfolio is paying you consistently an inflation-adjusted 6% a year, which equates to $60,000 a year, or that same monthly income of about $5,000 a month in the first year. Remember, the $5,000 is inflation adjusted, so it will increase annually. You're using the $5,000 a month income to live. That's what's paying your bills. So instead of spending down your money, those assets that you own are generating income for you. This is financial independence. There are a lot of things to say about each of the financial independence methods, but 3 important things I want to mention about the IGA method are, first, the $1 million is not what is being used to pay your lifestyle expenses, as is done with method 1. It is instead only being used to generate income. You can see what a huge advantage this is because you're not spending down that $1 million savings. It's there if you really need it in an emergency, but you're not living off of that. 2, the assets being used to generate the income do not necessarily have to be money. Remember, the income occurs without doing work you don't want to do. Everything requires some effort, but this is about, it's not about driving to a job every day anymore. These assets you use can be either skill-based or financial assets. I've done other videos on this where I talk more about it if you're interested in that. Please let me know in the comments if this makes sense to you, and also if you want me to do another video about this in more detail. And then 3, sometimes I get comments from people saying, oh, well, I make 7 to 10% a year from the stock market. That is their solution to financial independence. That sort of overly optimistic thinking is almost always based on inconsistent average annual returns in the stock market, not a consistent earnings in the stock market, because stock market is up and down. It's inconsistent from year to year. We can even have back-to-back years where the stock market doesn't have capital gains, whereas income can keep coming even from stocks or other assets. That income keeps paying out for the most part, even when stocks fluctuate in price. So income is different from capital gains. So think of it in that way. This is so important. I really want to mention it again. Is when you hear, oh, I'll make 7% a year or 10% a year from stocks, that is not consistent income. That is based on capital gains. That is based on a long-term average. That's not year to year. You don't get that every year. And with this financial independence method, the second one, the IGA method, the income is being generated in a source or from a source that is much more consistent and predictable than those unpredictable capital gains that might come from stocks. We just can't assume that that's going to keep happening because we've been in this bull market since 2009 for the most part, and we've had these fantastic returns, but we can't assume that's going to continue happening. The fact that it's happened for so long, for so many years, in fact, makes it riskier to be in those assets and think that it's going to continue happening in future years. There's a reason returns were so great, and that was largely due to interest rates being very, very low and or declining during that time, and also Federal Reserve actions that helped stimulate the markets and both real estate and also stocks, as well as the bond market, because as interest rates go down, the value of bonds go up and vice versa. As you've seen though, interest rates have been higher for a while now lately. Okay, so let me get to financial method, independence method number 3. Okay, financial independence method 3 combines the AAS method and the IGA method. So I like to call this the combo. For example, someone may withdraw $2,000 or $25, let's say $2,500 a month from their accumulated retirement savings. And they may also generate $2,500 a month in extra income outside of that traditional retirement portfolio. So they're using that first method to just spend down that money that they've accumulated, that they've saved, and then they're also generating an extra $2,500 a month in income outside of that traditional portfolio. Now, those traditional portfolios, they do generate a little bit of income, as I've mentioned, from the dividends and or the interest that are paid, that are earned from the stocks and the bonds. But this is in addition to that minimal earnings that you're getting in income from the retirement portfolio. That's the combo method. And let me say that this is my favorite financial independence method for so many different reasons, and the method that we have chosen to use. It makes a lot of sense. It's diversified. When one thing is working, or not working, the other thing will be working. So I love having that flexibility of these two different methods. There are pros and cons of each financial independence method. If you're interested in hearing more about the pros and cons of these financial independence methods, please let me know in the comments section. If enough of you are interested, I'll do another video on it. And if you have any questions or comments about it, I'd love to hear about it. I'd love to hear what it is you want me to make videos about in relation to this. This is the kind of thing that I know about. It's what I do. It's what I've done for decades. And I'm happy to make videos. I'd like to make videos about what you all want to hear about. So if enough of you are interested in a particular topic, please let me know in the comments section. And remember, retire certain.